Vienna, May 11, 1931. You're standing outside Creditanstalt, Austria's largest bank. The bank that controlled 70% of Austrian industry. The bank that had never failed, that couldn't fail. The doors are locked. A handwritten sign reads "temporarily closed." Around you, hundreds of people are screaming, pushing, trying to force their way inside, because their life savings are in there, every shilling they've ever earned. And the bank just announced losses equal to 85% of its total equity. Not 85% of profit, 85% of everything the bank owned. By the time the dust settled, depositors lost everything. Not most of it, everything. And here's what keeps me up at night. Almost nobody saw it coming. Not the depositors who trusted the largest bank in Austria. Not the investors who bought its stock. Not even the Austrian government that had guaranteed its stability. They all believed the same thing, too big to fail, and they were catastrophically wrong. This wasn't 2008, this was 1931, and it triggered a banking crisis that spread across Europe in weeks, collapsed governments, destroyed currencies, and helped create the conditions that led directly to World War II. I went through the forensic record, the bank statements, the government reports, the personal diaries of people who lived through it. What happened in Vienna in 1931 follows a pattern that has repeated in every major banking collapse in history. And by the end of this video, you'll know exactly what that pattern looks like, who survived, what assets held their value, and why the warning signs are visible right now, if you know where to look. Let me show you how a bank that was literally too big to fail destroyed an entire continent's financial system in less than 60 days. Before we dive in, understand this. Banking collapses follow a script. It's mathematical, it's predictable, and it always starts the same way. Stage 1, the bank makes bad loans during good times. Stage 2, economic conditions change and those loans go bad. Stage 3, the bank tries to hide the losses. Stage 4, someone discovers the truth. Stage 5, depositors panic and the bank implodes. Creditanstalt hit all 5 stages in perfect sequence, and almost nobody saw it coming because they were looking at the wrong signals. Creditanstalt wasn't some small regional bank. This was Austria's financial backbone. Founded in 1855 by the Rothschild family, it financed railways, steel mills, factories across the Austro-Hungarian Empire. By 1931, it held 2/3 of Austria's bank deposits. It controlled major industrial firms. It was intertwined with the government itself. When you deposited money at Creditanstalt, you weren't just trusting a bank, you were trusting the entire Austrian financial system. That trust was about to be shattered in the most devastating way possible. Here's what the forensic record shows about how it actually happened. The first crack appeared on May 8, 1931. Creditanstalt published its annual report. Buried in the numbers, a single line, the bank had sustained losses of 140 million shillings. The bank's total share capital was only 166 million shillings. That meant 85% of the bank's equity had evaporated. Not from a single bad trade, not from a sudden market crash, from years of accumulated bad loans that the bank had been quietly hiding on its balance sheet. The Austrian government immediately pledged support. The Rothschilds injected capital. Foreign creditors were assured everything was fine, none of it mattered, because once depositors understood the bank's capital was gone, the logic became brutally simple. If everyone tries to withdraw at once, the bank runs out of money. If the bank runs out of money, the last people in line lose everything. Therefore, you must be first in line. On May 11th, the bank runs began. Thousands of Austrians descended on Creditanstalt branches across Vienna. They demanded their deposits in cash. The bank couldn't meet the demand. By law, banks only keep a fraction of deposits as reserves. The rest is lent out. When everyone wants their money back simultaneously, the math doesn't work. The bank simply doesn't have it. Here's the detail most people miss about why banking collapses spread. Creditanstalt didn't just hold Austrian deposits. It held deposits from German banks, Czech banks, Hungarian banks. It had borrowed from banks in London, New York, Paris. When Creditanstalt froze withdrawals, those foreign banks couldn't access their funds, which meant they couldn't meet their own withdrawal demands. The crisis spread like a virus through the European banking system. By June, bank runs had reached Germany. Danette Bank, one of Germany's largest commercial banks, announced on July 13th that it couldn't meet its obligations. The German government declared a bank holiday. 4 of Germany's 5 major commercial banks were placed under public control. The entire German banking system had frozen. By September, Britain was forced off the gold standard. The British pound, one of the world's reserve currencies, was cut loose from gold backing. The crisis that started in Vienna in May had destroyed the European financial system by autumn. And here's what the autopsy reveals about who survived and who didn't. Physical gold holders came through completely intact. While bank deposits were frozen and currencies were devalued, gold maintained its purchasing power. People who had converted savings to physical gold coins before the crisis could still access their wealth. The mechanism was identical to every banking collapse in history. Assets inside the banking system can be frozen. Assets outside the system cannot. Foreign currency held outside banks worked the same way. Austrians who had kept US dollars or Swiss francs in physical form could still use them. The currency itself wasn't the protection. Being outside the banking system was the protection. Productive land under direct personal control survived. Farmers who owned land outright and could produce food weren't dependent on the banking system functioning. They maintained real wealth regardless of what happened to paper assets. But here's what went to zero. Bank deposits. Austrians who had trusted the largest bank in the country lost everything. Not 50%, not 80%, everything. Stocks in Austrian companies collapsed as the economy contracted 20% over the next 2 years. Corporate bonds became worthless as businesses failed. Real estate prices cratered as foreclosures accelerated. Anyone whose wealth was denominated in Austrian shillings and held inside the financial system was destroyed. Now here's where it gets interesting. The people who survived weren't the smartest investors. They were the people who understood one thing that everyone else missed. The system itself was the risk, not individual banks, not specific investments. The entire interconnected banking system built on fractional reserves and over-leveraged balance sheets. Let me show you the parallel that nobody wants to talk about. March 2023. Silicon Valley Bank fails. The 16th largest bank in the United States. Depositors panic. Within 48 hours, $42 billion in withdrawals. The bank collapses in the second fastest bank failure in U.S. history. The government steps in with emergency measures to protect depositors. Crisis contained. Or was it? Here's what the forensic record from 1931 teaches us about how banking crises actually spread. The failure of one bank isn't the crisis. It's the signal that reveals the underlying fragility of the entire system. Creditanstалт's collapse didn't cause the European banking crisis. It revealed that European banks were already over-leveraged, undercapitalized, and interconnected in ways that made contagion inevitable. Silicon Valley Bank's failure revealed something similar. Regional banks across America were sitting on unrealized losses from bonds that had collapsed in value as interest rates rose. Those losses weren't marked on balance sheets, but they were real. And when depositors started questioning whether their banks were safe, the same logic that destroyed Creditanstalt in 1931 started playing out in 2023. If everyone withdraws at once, the bank fails. Therefore, withdraw first. The FDIC stepped in. The Federal Reserve created emergency lending facilities. The crisis was contained. But here's the question the 1931 autopsy forces us to ask. Was the crisis actually solved, or was it just postponed? Because here's what happened after Creditanstalt. The Austrian government guaranteed deposits. The central bank provided emergency liquidity. Foreign creditors extended new loans. And for a few weeks it looked like the crisis was contained. Then the contagion reached Germany. Then Britain. Then the United States. By 1933, the entire global financial system had restructured. Currencies were devalued. Banks were nationalized. The gold standard was abandoned. The system didn't recover. It was rebuilt from scratch. Now let's talk about what's happening right now that follows the same pattern. U.S. commercial real estate is sitting on approximately $1.5 trillion in loans. Office vacancy rates in major cities are running 20% to 30%. Building values have declined 30% to 50% in some markets. Banks are holding those loans on their books at values that no longer reflect reality. This is the exact same dynamic that destroyed Creditanstalt. Bad loans accumulated during good times. Economic conditions changed. Asset values collapsed. Banks hide the losses on their balance sheets. Until they can't. Regional banks hold approximately 70% of commercial real estate loans. These aren't the too-big-to-fail banks that got bailed out in 2008. These are the mid-sized banks that serve local communities. When those loans go bad, the losses will hit banks that don't have the political connections to guarantee a bailout. The FDIC insurance fund holds approximately $128 billion. Total insured deposits in the U.S. banking system are approximately $10 trillion. The FDIC can handle a few small bank failures. It cannot handle a systemic crisis where multiple large banks fail simultaneously. The math doesn't work. Here's the pattern from 1931 playing out again. Stage 1. Banks make bad loans during good times. Commercial real estate loans made when office buildings were 95% occupied and interest rates were near zero. Stage 2. Economic conditions change. Remote work reduces office demand. Interest rates rise. Property values collapse. Stage 3. Banks try to hide the losses. Mark-to-market accounting suspended. Loans extended and pretended rather than written down. Stage 4. Someone discovers the truth. Silicon Valley Bank was the canary in the coal mine. Stage 5 is what we're watching for right now, the moment when depositors lose confidence and start moving money out of regional banks, because once that starts, the same logic that destroyed Creditanstalt takes over, and no amount of government guarantees can stop a bank run once it begins. The Austrian government guaranteed Creditanstalt deposits. The bank still failed. The German government declared a bank holiday. German banks still collapsed. Government intervention can delay a crisis. It cannot prevent a crisis when the underlying math is broken. So where are we seeing the warning signs right now? First National Bank of Lindsay, Oklahoma, failed January 31, 2025. The First Bank, Puerto Rico, failed January 17, 2025. Republic First Bank, Philadelphia, failed April 26, 2024. These aren't major institutions. They're small regional banks, but they're following the same pattern. Bad loan portfolios, commercial real estate exposure, depositor flight. One bank failure is noise. A pattern of bank failures is a signal. The question is whether anyone is paying attention before the pattern accelerates. Bitcoin hit all-time highs above $109,000 in January 2025. Gold reached record levels above $2,900 per ounce. Central banks globally bought over 1,000 tons of gold for the third consecutive year. These aren't random market movements. These are the actions of people and institutions hedging against the exact scenario that played out in 1931. Loss of confidence in the banking system. Loss of confidence in fiat currency. Flight to assets that exist outside the system. Here's what the forensic record from Austria 1931 tells us about what actually preserves wealth when banking systems collapse. Not the highest returns. Not the most sophisticated strategies. The simple, brutal distinction between assets inside the system and assets outside the system. Inside the system means your wealth depends on institutions functioning, contracts being honored, governments backing their guarantees. Outside the system means your wealth exists regardless of whether any institution survives. Physical gold and silver held in your direct possession, not gold ETFs, not gold certificates, not gold in a bank vault. Physical metal you control. Foreign currency held outside the banking system, cash in a safe, not a foreign currency account at your local bank. Productive land you own outright with no debt, land that produces food or can generate income regardless of what the financial system does. Skills that have value in any economic environment, medical knowledge, mechanical repair, agricultural production, things that cannot be frozen, devalued, or confiscated by institutional failure. The people who survived Creditanstалт's collapse weren't the ones with the most money in the bank, they were the ones who had moved their wealth outside the bank before it was too late. The people who survived the German banking crisis weren't the ones with the largest stock portfolios. They were the ones who held physical assets that didn't depend on financial markets functioning. The people who survived the Great Depression weren't the ones with the most sophisticated investment strategies. They were the ones who understood that when trust collapses, simplicity wins. Here's the lesson that 1931 teaches and that 2025 is about to test. Banking systems are inherently fragile. They operate on the assumption that not everyone will want their money back at the same time. That assumption holds during normal times. It breaks catastrophically during crises. And when it breaks, the difference between survival and destruction comes down to a single question: is your wealth inside the system or outside it? The forensic record is clear. Every major banking collapse in history follows the same pattern. Over-leveraged balance sheets, hidden losses, a trigger event that reveals the truth, depositor panic, systemic failure. The names change, the countries change, the specific assets that fail change, but the pattern is mathematical, it's predictable, and it's repeating right now. Creditanstalt wasn't a random failure. It was the inevitable result of a banking system built on leverage, hidden risk, and the assumption that growth would continue forever. Silicon Valley Bank wasn't a random failure. It was the signal that the same dynamics are present in the current system. The question isn't whether the pattern will complete. The question is whether you'll position yourself before it does. The Austrian depositors who lost everything in 1931 weren't stupid. They weren't reckless. They trusted the largest, most stable bank in the country. They trusted the government guarantees. They trusted the system. And the system destroyed them. The people who survived were the ones who understood that trust itself was the vulnerability. That the safest position during a banking crisis isn't the best bank. It's outside the banking system entirely. If this forensic breakdown gave you a new lens for reading what's happening right now, hit subscribe. This is Independent Financial Historian. I examine what actually happened in history's greatest financial collapses so you can recognize the pattern before it reaches you. Drop a bank emoji in the comments if you're already positioning outside the system. Tell me what you want me to dig into next. I read every single one, and remember what the Austrians learned in 1931 the hard way. The biggest risk isn't being in the wrong bank. It's being in the banking system at all when trust starts to crack. The collapse nobody saw coming wasn't because there were no warning signs. It was because everyone was looking at the wrong signals. They were measuring the bank's size, its history, its government backing. They should have been measuring the one thing that actually mattered, whether their wealth could survive. If the bank didn't, build your protocol before you need it. Because by the time the doors close and the sign goes up, it's already too late.